I have been covering some of the best ETFs for maximizing dividend income, and high income ETFs, more specifically covered call ETFs, have quickly become one of the biggest trends among retail investors. For those unfamiliar, these are funds that sell call options on their underlying holdings to generate premium income, which is then distributed to investors as dividends. The income they produce not only delivers a steady stream of cash flow, but also helps cushion downside volatility by offsetting declines in stock prices. And in my view, that is one of the greatest strengths of high-income ETFs. They let investors maintain market exposure while softening the impact of downturns. Yes, the yields are attractive, but it's important to remember that the true purpose of these ETFs is twofold: to generate reliable income while minimizing overall portfolio volatility. Now, aside from breaking down ETF strategies to identify which ones are most effective for different types of investors, I also focus on ETFs when specific opportunities arise for market shifts, sentiment, or catalysts. And right now, the two biggest catalysts are inflation and interest rate cuts. Rate cuts are generally viewed as bullish for equities since lower borrowing costs make it easier for companies to expand, helping to boost revenues, profitability, and margins. But the key is understanding why the Fed is cutting rates. If it's to stabilize a cooling economy, equities often react positively. But if it's to counteract deeper structural problems, then that could lead to renewed volatility or even a sell-off. Now, aside from that, certain sectors are especially sensitive to rate decisions. Technology, for example, tends to respond strongly to cuts. And dividend stocks often benefit as well, as conservative investors rotate into dividend ETFs when yields on fixed income assets fall in line with rate cuts. There's one sector, though, that many investors are watching closely, and analysts like Tom Lee believe it could not only outperform the S&P 500 in the coming years, but potentially double its performance, and that sector is small caps. Just last week, small cap ETFs like IWM, which tracks the Russell 2000, jumped nearly 6%. But within the high income space, there's one ETF that in my opinion really stands out. It gives investors broad exposure to small caps while layering on a high income strategy, delivering a yield of over 15%. This is actually an ETF that I highlighted in both my course and my private group about a month ago, notifying investors right before it skyrocketed, once again delivering double the performance of the S&P 500. And that brings me to IWMI, the NEO's Russell 2000 High Income ETF. In my opinion, for investors looking to capitalize on the opportunity that interest rate cuts create for the small cap sector, IWMI is one of the best positioned ETFs for this opportunity. What makes it especially appealing is its high income approach, which helps offset some of the inherent risks of small caps. That means even conservative investors, or those who want to participate without taking on the full volatility of the sector, have a more risk-averse avenue to consider. But rate cuts aren't the only catalyst here. There's another set of crucial data that I've uncovered that further strengthens the case for small caps in the years ahead, including valuations, price-to-earnings ratios, and how those line up with the broader economic backdrop. This is information every investor needs to understand before it's too late. So make sure you stick around until the end because you do not want to miss this. This ETF was established in June of 2024, so it is extremely new, but despite its recent inception date, it already has close to $500 million of assets under management. Now, all NEO's ETFs carry a similar expense ratio of 0.68%, which is on the higher side. However, IWMI makes up for it with a dividend yield of nearly 15%, which is the highest among NEO's high-income lineup, even compared to funds like QQQI and SPYI. The fund has actually managed to outperform its underlying index, the Russell 2000 IWM, and that is what really caught my attention. The outperformance comes directly from the large amount of premium income it generates, which translates into an exceptionally high dividend yield. You can see this effect clearly during the April sell-off. IWMI managed to cushion the downside by more than 3% compared to IWM, a much higher dampening ratio than what the SPYI provided relative to their benchmarks. When you line up the total return charts of SPYI versus SPY and IWMI versus IWM, the difference is very interesting, and the reason comes down to volatility. The small cap sector is inherently more volatile than the S&P 500 because large cap stocks don't swing nearly as much in price as smaller companies. And in options trading, option prices are directly tied to the volatility of the underlying asset, a relationship known as vega. The more volatile the asset, the higher the premiums on its options. And for a fund like IWMI, which sells call options, that means significantly more premium income. And that income ultimately cushions volatility and extremely well. Now, aside from ETFs, when it comes to portfolio construction, I like to complement my allocations with individual stocks as well. One of my favorite tools for this is ProPix AI. This feature builds model portfolios based on different strategies, and it is designed to outperform benchmarks. And there are many powerful portfolio options you can choose from, such as tech titans, Warren Buffett's top 15, healthcare heroes, small cap sprinters, or the S&P 500 value portfolio. Every portfolio includes a detailed breakdown of each stock's financial health, earnings, cash flow, valuation, and even timestamps of when the position was opened or closed. I'm very excited to share that investing.com has officially launched their New Year's sale where you can get up to 55% off their plans. And if you use my link, you will get an additional 15% off on top of that, which means you can get up to 70% off. Investing Pro gives you access to a massive database of global stocks and ETFs, which is backed by deep financial data, research tools, portfolio analytics, and both technical and fundamental insights. You'll also find portfolios from top fund managers like Ray Dalio and Warren Buffett, which you can analyze or even replicate directly inside the platform. As always, past performance is not indicative of future results, and this is not financial advice. I am simply sharing one of the tools I personally use to enhance my own research. Another one of my favorite features is Warren AI, which is like their version of ChatGPT, but with access to a real financial database. So when you ask it a question, the response isn't just surface level, it is backed by actual data and analytics from their system. There's a lot to explore inside the platform, and if you'd like to check it out, you can use my link or code Victoria Media to get an additional 15% off, for a total savings of up to 70% off. When you compare IWMI to IWM, you can see that IWMI consistently carries lower volatility, which translates into a significantly lower beta value. As a result, the fund has managed to deliver stronger risk-adjusted returns, achieving both a lower standard deviation, a higher Sharpe ratio, and a higher Sortino ratio than IWM itself. Now, to be honest, when it comes to capitalizing on high growth opportunities, covered call ETFs are not the most ideal avenue, and that is simply because you're trading off some of the upside potential in exchange for premium income. So if growth is your sole objective, then a straight allocation into something like IWM would offer more upside, though it also comes with higher volatility. With that said, one thing that really stands out about NEO's ETFs is how actively they manage their covered call strategy. They aren't just passively writing options, they adjust to market conditions to ensure they're still capturing meaningful upside during rallies. On top of that, they use call spreads, which further allows them to participate in market gains rather than capping all of their upside. I'll explain how this works in just a moment. This active management style approach is something that I've noticed playing out well in other NEOS funds like QQQI and SPYI, which were able to capture the majority of the market's rally following the April sell-off. And that's exactly why IWMI has caught my attention right now. So with that being said, let's break down how this fund works and why I believe it's such a strong option for investors heading into this market environment. Similar to other NEOS funds, IWMI uses a covered call strategy, deploying roughly 70 to 100% of its assets to sell call options that are about 2 to 5% out of the money. This approach gives the underlying small cap stocks some room to appreciate while still generating a meaningful amount of option income. But IWMI doesn't stop at just selling calls. The fund managers also purchase call options on the Russell 2000 index to help capture additional upside momentum. When the index rises, the value of those calls increase, giving the fund leveraged exposure with only a small allocation of assets. And since only a small portion of the fund is used for this strategy, it doesn't introduce major risk, though it does contribute to a higher expense ratio since the managers are constantly active in the options market. Another key strength of IWMI is its diversification. Like IWM, it holds over 2,000 individual companies. And the reason I find this important is because many alternative small cap ETFs tend to condense their holdings to only a few hundred, which inherently brings on much more volatility. But by keeping it simple, providing the same exposure and layering a covered call strategy on top, it helps reduce the sector's volatility. So that raises the bigger question. Why are small caps especially favorable in a rate cutting environment? And what is the other catalyst that could drive the sector even higher? As I've mentioned in a previous video, small cap companies rely heavily on external financing to fund growth and expansion. The majority of these businesses are barely profitable and carry substantial debt, which makes borrowing costs a critical factor in their performance. Now, another factor is that large cap companies often use fixed rate debt, but small caps tend to rely heavily on variable rate debt. That means when interest rates rise, their borrowing costs jump significantly, and that directly hits their earnings. And since interest rates have stayed elevated for years now, the small cap sector has remained beaten down for over 3 years. While large caps, especially mega cap tech stocks, have soared, small caps haven't had the same runway to recover, despite the fact that many hold promising names that could play a huge role in the AI revolution. And that leads us to our second catalyst, which is valuations. Historically, since 1987, small caps have traded at a slight premium to the S&P 500, with higher forward price to earnings ratios. Investors have traditionally been willing to pay more for small caps because of their higher growth potential. But with interest rates elevated, small caps are now trading at a deep discount, nearly 50% below the S&P 500 on a forward PE basis. Right now, small caps would need to double, rise by 100% just to get back to their historical valuation relative to large caps. That's why analysts like Tom Lee continue to highlight small caps as one of the most attractive opportunities in the market right now. Of course, there are risks and inflation remains the biggest concern. But overall, small caps are very much in focus right now. And for investors who want exposure to this opportunity without taking on full volatility and downside risk, ETFs like IWMI, with its extremely high 15% dividend yield, can be a powerful way to both boost portfolio income and position for potential small cap outperformance. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.